Hi, this is Mr. Evans. This video is looking at finance, the key bits from the finance unit in preparation for GCSE AQA paper 2. Okay, so first thing to know is your finance basics. All right, so that's revenue, total revenue, sales revenue, all the same thing, calculated by price times quantity. It's just different ways of saying the same thing. Okay, price times quantity is how you calculate revenue. Cost and price are two different things in business. Okay, the price is how much the consumer pays to own a product. It's how much the business charges a customer when they sell a product to the customer. The cost is incurred by the business as they manufacture a product. Okay, so a business calculates its total cost by adding its variable costs or its total variable cost to fixed costs. Its profit, whether or not it's made a profit, is determined by whether or not the revenue earned from sales is higher than the total costs incurred in earning those sales. So we just do total revenue minus total costs. If total cost is higher, they have made a loss, and this will come out as a minus number. All right. This is exactly the same formula, just expressed in a slightly different way. Okay. Average unit cost is total cost divided by quantity. That tells you how much, on average, each unit of output costs the business to make. So they're your basics that you need to know. All right. Now, the first slide I've got here is on a topic that students find difficult. It's the difference between cash flow and profit. All right. So in this example, I've got a luxury furniture manufacturer selling a sofa for £6,000. The client is paying in 3 monthly instalments of £2,000. Kelly's costs are £4,000. So how much profit? Easy. 6,000 minus 4,000 equals 2,000. No problem. But the cash situation is going to look very different. She's paying her 4,000 up front. So in month one, here we can see what her cash looks like for this particular job. So at the start of month one, she's got no money, right? She spends 4,000 on her materials, wages, etc. She only gets 2,000 in though in month one because the client's paying in 3 installments. Okay, so 2,000 in, 4,000 out. So at the end of month one, although she's recorded £2,000 profit on the job, she's actually, in cash terms, she's £2,000 down. Okay, 2,000 down. That's what the brackets mean here. Okay, and we can see her inflows and outflows, the net cash flow, and the end of the month. Right. So if at the end of month one she's 2,000 down in her bank, her cash, right, that's where she starts month two. In month two, great on outflows, okay, and month three because she's paid all her costs for this job, but she starts £2,000 down. She collects £2,000 from the customer. That's 2,000 net cash flow. At the end of the month, she's at zero, okay, because she had 2,000. She was in her overdraft by 2,000, and she gets to zero at the end of month two. Month three, she finally realizes her 2,000 profit because still no costs. She collects her final 2,000 from the customer, and then her cash reflects the profit that we recorded when the sale was made, but that was 3 months ago. So cash flow and profit are different. This is very difficult for people to understand. Okay, a profit occurs where total revenue is higher than total cost. We've mentioned that before. Cash is immediately available for the business use. So there's a bunch of reasons why cash is different to profit. Okay, reason one is what we've just gone through. The business records a sale, but the customer pays on credit. So we record a revenue as soon as we record that sale. That's legal, we can do that, but we haven't yet received the cash. Okay, we've given them credit. So there's nothing illegal going on. It's just the fact that due to the nature of accounting, I record the revenue when the customer agrees to buy the product at this price, but they're going to pay me later on. So no cash received. All right. Equally, I might record a cost when I receive some products, okay, but I've got 3 months to pay for it because I've got trade credit from my supplier. In this case, I'm recording a cost, but no cash leaves my business for a while. So although it looks like I've spent a load of money, actually no cash has left my account. All right. What about other forms of inflows to a business? So selling shares, taking out a loan. I'm getting an inflow of cash. I've got loads of cash now, but it's not profit because it's not revenue. All right. The owners of the business might take out a massive chunk of cash from the bank account. In that case, we've got a whole bunch of cash leaving, but it's not exactly a business cost, right? So it's money being taken by the owners. So again, cash profit, very different. There's other reasons as well. Okay, but they're different. Here's a cash flow forecast. You need to know how to calculate them. This version actually looks might be a little bit more self-explanatory. Okay, when you're calculating a cash flow forecast, it won't look like this because I've made this one a little bit simpler, hopefully, so you can see what's going on. But when you're filling in a cash flow forecast or reading it, go down the column and then read left to right. Okay, so what do I mean by that? Okay, so net cash flows, inflows minus outflows. So why have we got 200 here? Because in January, 1,000 came in, 800 out. So our net cash flow is 200. All right, you'll see the net cash flow is repeated down here. So this is why it won't look like this in the exam, because I've got the same thing twice, basically. But just to show you how it all works out. So inflows, that should be minus outflows. Apologies about that. That's total inflows minus total outflows. 1,000 minus 800 equals 200. Okay. The opening balance, imagine they had 100 in the bank account at the start of January. Add 200 to it. That gives us our closing balance of 300. Okay. We need to carry now that closing balance from January over to the opening balance in February. Okay. And then you can see the same patterns here. Okay. February's far worse for the business in terms of cash flow because I've got 1,500 coming in and 2,000 leaving. Of course, check up here because they'll try and trick you with this in the exam. This isn't actually 2,000 leaving the bank. It's 2 million, okay? Because they've stated up here that these are thousands. So 2,000 is 2 million, right? That's a net cash flow of minus 500,000, 500,000, right? Because I need to add that on. Okay, so this is what it will actually look like in the exam, the net cash flow here. But hopefully you can read that a bit simpler. All right. So this is your break-even chart, and I had hoped to animate these in, but I couldn't make it work with the image that I've got. Right, so you need to know how to label all of these lines. This is my sales revenue. Starts at 0. Okay, if I sell no units, I get 0 revenue. Ends up here. And the other thing that starts at 0 is my variable cost. If I'm making no units, I have no variable costs. So that starts at 0 as well. The fixed costs, my fixed costs don't change regardless of output. So these are the same. Along this axis here, we've got output, right? And this is saying it doesn't matter what the output is, my fixed costs are always the same because fixed costs do not change with output, at least in the short term. All right, so where does this line come from? The final one. This line here, the total cost line, as we know, is simply your fixed cost plus your variable cost line. So it starts at 0 output. I've just got to pay my fixed cost. There's no variable costs. So total cost is going to equal fixed costs at 0 output. And then it progresses linearly in line with the variable cost line. I'm not sure that linearly is a word, but there we go. Right, average rate of return. Okay, so when I put savings in a bank, I'm hoping for a return. Okay, my return is the percentage I get back on my savings. So that's called an interest rate. Okay, so whenever I am looking at an investment, okay, putting my money into something, I want to compare it to the interest rate I could get in the bank. All right. Now, businesses are exactly the same. Businesses have bank accounts. The safest thing a business can do with its money is put it in the bank. So whenever a business invests in something, be it a new fleet of vehicles, a new computer system, an advertising campaign, it wants to look at that money and think, well, what is the return I'm going to get on my investment, my ROI? My ROI, what's my return on investment? An average rate of return allows you to calculate this. It's average annual return divided by initial cost times 100. Okay, return simply means profit. They're just two words meaning the same thing. So it's easiest to show you this with an example. So a business is going to spend 200 million on a new factory, leading to profits of 150 million over 6 years. Okay, so the formula Average annual return divided by initial cost times 100. Fine. What's the average annual return? Well, it's simply 150 divided by 6. It's going to make 150 over 6 years. So the annual return, the average each year of profit that I earn is 25 million per year, right? 25 million additional in profit on expenditure of 200 million. Okay. So I can apply my formula now. I know the average annual return because the initial cost is 200 million. So 25 million divided by 200 million times 100 gives me an average rate of return of 12.5%. And I can think, well, as a business, the sort of return, the base rate of interest is 4.25% as I speak today in 2025. No savings account really gets that anyway. So your savings account probably returns 2 to 3%. So 12.5% is a much better return. This looks like a reasonable investment for a business over 6 years compared to putting your money in a bank. All right, income statements. So an income statement, what an income statement does is it simply tells a business, has it made a profit or a loss, usually over 1 year. Okay, so you need to know how it's laid out. It's sales revenue minus cost of sales, that equals gross profit. So 100 minus 75 is 25, all right? Sales of 100,000, of course, because I've got that up here, minus 75,000 cost of sales. Your cost of sales is simply your variable costs of production, all right? And that gives me what's called gross profit. I need to know this, guys. Gross profit minus expenses equals net profit. Okay, so simple numbers. Right, make sure you know this. Okay, so often they ask a question like calculate gross profit and they give you sales revenue, cost of sales, and expenses. Right, they're trying to trick you. Right, you don't need the expenses to calculate gross profit, but unless you know this off by heart, you're going to get caught out. So make sure you know this. Gross profit and net profit margin, you also need to know. Profit margins are simple. It's just profit divided by revenue times 100. And all that's telling you is what percentage of my sales revenue did I convert into profit. In this case, I converted 25% of my sales revenue into profit and 5% into net profit. Okay. Obviously, higher is better for those. All right, now this is probably the most difficult thing that I experience that students struggle with. This is the statement of financial position. Right, you can pretty much disregard the bottom bit. Okay, in fact, I might just get rid of it here to make it easier to talk about. They've never asked a question on this, but should it come up, it's net assets is equal to total equity. I'm just going to get rid of it while we speak about this. So let's just delete that. Okay, so now you can see it maybe a little bit better without all that extra information. Okay, so what are we doing in here? Okay, so the statement, the income statement, which we saw before, that just tells you over the course of the year, did the business make a profit? This tells you if I add up everything the business owns, they are assets, and I subtract my liabilities, okay, everything I owe, how much money is left over, right? And this business has got 950 in assets. It's got 350 plus 80, which is what, 430 in liabilities. 850 minus 430 equals net assets of £420,000. What does that mean? It means if I'm an owner of the business and I decide that I've had enough today, if I liquidate my assets, if I turn my assets into cash, I get 850,000. If I pay off my debts, which are 430,000, I am left. I walk away with £420,000 cash. That is how much my business is worth. Okay. The formula is simply for net assets is simply total assets minus total liabilities. The other thing, okay, this hasn't been quizzed very often on AQA, hasn't been assessed. You haven't needed to know this before, but current assets is cash I'm going to get in this year. Current liabilities is cash I owe this year. So you always want your current assets to be higher than your current liabilities. What this shows is I should have enough cash to get through the next